Welcome back to Mark Arnold's Finance. Today we're going to talk about some market news. Now it's good to keep up with the market. It's not that it's going to change your strategy of what you invest in and how you invest, but it could help you determine when to buy the companies that you already hold in your portfolio or maybe open a position in a new company. So the main story remains the Federal Reserve. After a historic series of rate hikes to combat inflation, the Fed is now in a holding pattern. The latest inflation numbers came in slightly cooler than expected, but core services inflation remains sticky, preventing a declaration of victory. Now, the Fed is truly data dependent. Job growth has moderated from its red hot pace, but wage growth is still strong enough to concern policymakers. They're stuck between a rock and a hard place. Cut rates too soon and risk reigniting inflation, or hold them for too long and risk tipping the economy into a recession. Now, I know everyone has heard that Trump wants to fire Jerome Powell, which I think is highly unlikely, but that just shows how important these rates are to the economy, to the stock market, and your investments. So this is why you want to pay attention. Now, this uncertainty, which markets hate uncertainty, is causing choppiness in the markets. The bond market in particular is sensitive to every new piece of data. The 2-year Treasury yield is the one to watch. It's the market's best guess on near-term Fed policy. So what does this mean for investors? For now, higher for longer remains the base case. This environment tends to favor companies with strong balance sheets, positive cash flow, and pricing power. All companies that I own in my portfolio, which I'll let you see at the end of this video. It also makes cash and short-term bonds attractive as they offer a decent yield with relatively low risk. We are in a show-me market. Investors want to see proof of durable earnings, and we're seeing that now. Earnings season is picking up, and so far, overall, so good. I know ASML kind of had an outlook that wasn't great, but their earnings were still strong, the fundamentals of the company. Now, let's turn to a sector that's showing surprising strength, energy. For the last few years, the narrative was all about the green transition, but in 2025, traditional energy is making a powerful comeback. Geopolitical stability remains a key concern globally, and nations are prioritizing energy independence. This has led to renewed investment in traditional sources like oil and natural gas, especially in North American infrastructure and liquefied natural gas export capacity. Many large cap oil and gas companies are not spending aggressively on new exploration. Instead, they are using their record cash flows to reward shareholders through massive dividends and stock buybacks. That's why I think you see SCHD, a very popular dividend ETF, with a lot of the energy companies in its top 10, because they see this as well. And that's what they're providing to the people that own SCHD, because that's what they want. That's what they demand, is those growing high dividends. So I think that it's not a worry to me. I think some people worry about that with SCHD, but I think that was a smart move for this fund to include those. And this makes them very attractive to income-focused investors, both the ETF with the dividend energy companies in them, or just individually by themselves. I personally think it's too volatile to invest directly in companies. I do hold SCHD, so I get my exposure there, and I am fine with that. Now, this doesn't mean that green transition is over. Far from it, actually, but the path is proving more complex. Higher interest rates have made financing massive solar and wind projects more expensive. I have my opinion on those, but I will keep that for another video. However, government incentives are still in place, and areas like battery storage, grid modernization, and nuclear power are gaining significant long-term interest. Another way I'm getting exposure to this is by investing in the big tech companies, because those companies are investing in nuclear energy and other renewable and green sources as well. And so that's another way I'm getting my exposure, because they're starting to look in ways to power those, huge data centers or whatever it may be. They want to become less risky and more stable for their investors, and that's one way they're doing it. Now, the energy sector offers a dual opportunity. You have the high yield, value-oriented play in traditional energy, and the long-term high growth but higher risk play in clean energy and transition technology. So one to keep an eye on. I'm keeping out of it, but let me know if you invest in this area and why. Now, let's zoom in on one of the world's biggest companies. Not anymore thanks to Nvidia, but that's Apple. For the first time in a long time, Apple is seen as playing catch up in a key technological race, artificial intelligence. I thought at the very beginning of this, Apple would be the clear leader and winner, but they've lagged behind. In fact, there's been very little change over the last couple of years with the iPhones, and it's kind of disappointing. In fact, it is disappointing. So while sales of the iPhones remain robust, the growth story is shifting. Investors are now laser focused on Apple's AI strategy. Their recent Worldwide Developers Conference laid out a plan to deeply integrate AI into its iOS, Siri, and their core applications. Apple is trying to differentiate itself by focusing on-device AI, processing data directly on your iPhone rather than in the cloud. This is a massive selling point for privacy, a core tenet of their brand. That's why I like them and prefer Apple myself. So this is good news. Now the question is whether their on-device models can compete with the power of cloud-based competitors. So that is a concern and something we'll have to see how that develops. Let's talk about the Vision Pro headset real quick and how it's been on the market for some time already. While it's a technological marvel, sales have been modest, lackluster, shall I say, positioning it as a niche product for early adopters and developers. The market is watching to see if Apple can create a killer app that makes it a must-have device, but for now, it's not moving the needle on revenue. And I'll say this, with any wearables, Meta's tried, Snap, Google, I just don't think it's something yet that people want to do. They rather just look at a big screen. Yes, I've tried the Quest, and in the very beginning, I was bullish on it, but I kind of changed my mind because it's just not there yet. It's too heavy. I actually got vertigo afterwards after playing. My cousin said that kind of fixes itself over time, but I'd rather just play on the big screen, and I think that's how most people are still. So I'm not bullish on the headsets at this point. I think there has to be some better developments to make it easier, and we'll just see where it goes. But right now, it's been a huge kind of letdown for Apple investors with the Vision Pro headset. The bottom line for Apple, the stock's performance in the second half of the year will likely depend on two things: the reception of the new iPhone and the market's belief in its AI strategy. If it doesn't bring forth something meaningful with AI, I think Apple's going to continue to just kind of trade flat with its revenue. We will see it struggle there, and that can affect the stock price long term pretty deeply. But if they do come and knock one out of the park and there is something to get excited about, then Apple will be a great investment. But right now, I'm not in it because its revenue's been slowing down. The AI side of things has been a disappointment. So I have not, and I've never bought Apple actually. It was a great stock. Now it's just kind of, I think, a hold right now, seeing what they're going to do. Finally, let's talk about the world of digital assets. The crypto market of 2025 looks very different from the speculative frenzy of years past. The key term now is institutionalization. The launch and success of spot Bitcoin and Ethereum ETFs in the US have been a game changer. They have provided a regulated and easy way for financial advisors and institutional investors to gain exposure to the asset class, leading to significant new inflows of cash. Now, while a comprehensive framework is still being debated in Washington, the regulatory picture is becoming clearer. This slow march toward clear rules is reducing risk and making large conservative institutions more comfortable entering the space. Now, the buzzword you'll be hearing more of is RWA, or Real World Asset Tokenization. This is the concept of creating a digital token on a blockchain that represents a real-world asset, like a piece of real estate, a stock, a bond, or a piece of art. Major financial institutions are actively experimenting with this, seeing it as a way to make markets more efficient. But there is some investor caution. While the space is maturing, it remains highly volatile. Now, anywhere there's high volatility, I tend to stay out of it. Crypto's one of them. I know there's been some big gains in certain crypto investments. I've had some friends sell out early on. They could have been millionaires, they claim. But regardless, I'm happy with my stocks, my quality companies that I invest in, that I can tangibly see financial statements. And, there's proof of what they're innovating and investing in for the future. So it's just something I've stayed out of. But the days of chasing obscure coins for 100x gains are being replaced by more measured long-term thesis on blockchain technology itself. So there you have it. The Fed is holding its breath. The energy sector is firing on all cylinders. Apple is betting big on smarter iPhones, and the crypto world is putting a suit and tie on. Now, before we end this video, let's look at my portfolio. So right now, my portfolio at the beginning of this year was probably about 28% in the green. Now it's around 35%. So it's been holding very well this year. It's been doing great. I, of course, took advantage of the April dip with the tariff news. And since then, since I invested back in April, I've just been building up my cash position again. I think there will be some more opportunities this year. But you'll see there, Microsoft well over 100% in the green for me. It's been awesome. Yes, we've seen ASML dip this week due to their earnings, but I'm still 12.5% in the green. So this is where diversification of quality stocks and companies comes into play. While some drop, others rise, and it keeps your portfolio afloat. So that is my success in my portfolio, I feel, is finding those high quality investments, knowing that some will go up, some will go down, but overall it's a rising tide. So I am looking at a few stocks to invest in, which I will let you know if I make the move. But let me know what you think of these top market stories. And are there any stories that you're following that you think is important for us all to know because it affects our portfolios? I think the key takeaway is that we're in a complex market that demands a well thought out strategy. So again, mine is investing in high quality companies. That's all for today. We'll see you soon on Mark Arnold's Finance.